Hello, everybody, and welcome back to another episode of Miami Living with Levi. This is a real estate show where we talk about all things real estate and Miami related. We are here in the community newspaper studio today with our very special guest, my friend and longtime colleague, Alex Horn from Bridge Invest. Welcome, Alex.
Thank you, Levi.
Alex is one of the heads of Bridge Invest, the co-founders. Founder of Bridge Invest, which is a private equity firm that why don't you tell us a little bit more about what does Bridge Invest do?
Sure, happy to do so. By the way, Levi, I love the name of the show, Living with Levi.
Living with Levi.
I'm the managing principal of Bridge Invest. We are a real estate private equity firm focused majority in real estate debt, which means we focus specifically on lending. So predominantly we're doing senior secured first mortgages for commercial properties. So that means to us usually transactions that are between 10 and 100 million of real estate size. So they're predominantly commercial deals, typically a very special situations lending to pick up where kind of banks drop off. So your traditional bank will do your single family home, or they'll do, commercial building that's fully leased up and so forth. We do the stuff that's a little bit more esoteric, right? You're converting an old office building to multifamily, or you want to buy a retail property and then lease it up. Stuff with more complexity, where we can come in and do a more bespoke loan for you to get you in your next step in your business plan. So we've been doing that for about a decade. So Bridge Invest is homegrown. So started here in Coconut Grove, and now we're 2021 will be 10 years in business.
Oh, so we're coming up on a decade.
Yeah, a decade.
It's amazing.
And we do about $200 million of deals a year. And today, everything we're doing is out of our discretionary debt fund, which is it's a third discretionary debt fund. We just did another.
So you guys just did a round of fundraising, right?
We did. So I'm not sure if I'm allowed to say by SEC purposes how much we raised, but we raised a good amount of money. We have a ton of money to put to work. This in the first quarter.
Can we play hot and cold, or is that is it 100 million or 200? It's a sizable amount of money, we'll say.
Yes.
All right.
A sizable amount of money. I'll give you as a barometer. We did about $60 million of transactions in Q1 this year so far.
Very nice.
And we're hoping to continue to grow that. And we'll do deals all throughout the Southeast and Central U.S. So
you pick up where the banks leave off, meaning again, the banks might underwrite a traditional single family home, a primary residence, maybe a secondary investment property for one of their high net worth clients. They might have we have banks that are specific to asset classes that maybe they specialize in lending to a hotel, but generally speaking, when the waters get a little murky and it's harder for them to understand, they step back, and that's where you guys tend to step in.
That's correct in a way. And in a way, the traditional banks really focus more on cash flow and transactions that are operating, or they can see cash flow in the very, very near future. Our business focuses on doing those transactions that might be a few steps away from cash flow. So I can give you a few examples that are kind of local and people might know. So we financed the original purchase of the Mr. C property for Terra Group in Coconut Grove.
That's the Cipriani Hotel in Coconut Grove.
Exactly.
Beautiful hotel.
Not the new one they're building.
Oh, the Mr. C residence.
The residence.
Yeah.
Yes. So we financed that original acquisition.
So that was the initial acquisition of the land itself.
Yes.
And as sort of a bridge loan until they get their construction loan.
Right. So that one was actually very interesting because they've owned the land for a while. So it was actually not even land. It was a
building. Yeah.
It was a building. It was a multifamily building.
Mm-hmm.
So when they purchased it, their business plan was actually to take the property that was cash flowing it down to zero to then demolish it. Right. If you think about it, that's very counter to any business plan you have for a bank. Right. It's like you're reducing the cash flow, not increasing it. And so that's why we were a fit there, because we could underwrite that business plan for a multi-year sort of project, and we were able to lend what they needed to execute on their project.
What other projects have you guys worked on, and what size was that? Are you allowed to talk about the size?
Yeah, of the project specifically, I think it was about a $23 million loan, give or take. That was a few years ago at this point. Another project that's also kind of unique and talks about our skill set is if you're familiar with the Una residence.
Una, yeah, that's in the South Brickell area, just above the Rickenbacker Causeway, correct?
Correct. Yeah, it's 2 buildings in from Rickenbacker.
Yeah, and that used to be a what was it? Maybe a 15-story 1960s or 70s building. And again, they tore that down and they're putting up Una. Is going to be gorgeous.
Yeah, it's beautiful. So that's a good example of another transaction that we did that there was a building there, right? And it was a condo building. So Oko, who was the developer of the property, they had to go and buy unit by unit until they could collapse a condo and build a new project there. So when they came to us, we actually financed. It was something like 85% of the unit purchases. And I can't recall how many units it was, in the hundreds.
Wow. So as they were buying out the units so they can gain control of the association, you were funding the purchases of each individual unit purchase, because the plan was big picture.
Yeah, a big picture. And when they came to us, they already had kind of a critical mass. They had 80+% already under LOI to purchase.
Or they have to get to 90?
They have to. It's complicated. It depends on the building and the zoning and so forth.
The condo docs also. The condo docs,
yes,
municipalities
exactly.
change. Got it.
But they were at a point where they were close enough, and they already had kind of soft agreements with the other guys, the other few people in the building, that they would kind of convert those as well to contracts. So we financed effectively that purchase, and through our loan, they took over the building, they acquired the last few units, collapsed a condo, and then refinanced us out when they were planning on moving to the next stage in the business cycle of kind of launch of Una and pre-sale and so forth.
Gotcha. Because at that stage, there's more traditional lending that they can go get to do construction financing and more vertical.
Yes, we actually do a lot of construction financing as well. In that one in specific, they chose to go a different direction, but that's something that we were very active in. So, for instance, there's it's called the Ivory Hotel in Aventura,
Mm-hmm.
just off of Biscayne. I think it's on 213th. We just financed the completion of that construction loan. So they went vertical there, and it was an interesting building because it's part hotel and part office condos, and this is right next to the Aventura Medical Center. So we financed that ground up construction there.
Right.
And the reason that developer came to us was because it was a first-time developer in the U.S., but he had established track record of doing other projects before, and we were able to finance him and really allow him to get into that next stage of his business plan to complete the project. We have since actually done another loan for him for the building for the land directly in front of him, in front of that property, which is on the corner of 213th and Biscayne, which is going to be a very exciting.
On the corner of 213th and Biscayne, do you know if it's the east or west side? Or?
West side.
On the west side.
On the east, it's already developed, right?
Yeah.
On 213th, it's
already like
the
golf. Yeah, you have all the whole shopping plaza there.
Correct.
So this is on the west side, closer to the train.
Yeah, they're actually going to develop a whole new. There's going to be a whole new light there and another through street, so it'll actually create better access in that area too.
Nice.
So those are examples of transactions we're doing down here, but we're fairly active throughout the southeast and central U.S. So we've closed. I think this year so far, we've actually done a majority of our business in Atlanta. We found that it's been a very interesting market with a lot of great development going on there, and we've been happy and fortunate to be able to participate in that.
Got it. So I mean, we all know. I mean, we've talked about it many times on this show that the market here in Miami is absolutely raging. It's on fire, and there's very little inventory, very little opportunity to find. You have to really get creative to find. Especially for developers, there are people that are now looking. I've seen a lot of interest in building office spaces, just because with the influx of high net worth people that are coming here, there's going to be a high demand for Class A offices. So I know there's people in the Grove building offices and looking to build offices in the Grove. We had Lyle Stern on the show who talked about the city building office, putting out a bid for office spaces in South Beach in various different parcels that the city of Miami Beach owns, and they were talking about doing that. So what are the trends, I'm guessing, that you're seeing both here, I guess, and around the country? I mean, you're saying you do a lot of business in Atlanta. What asset classes are you seeing like the most demand?
So I'll start off with first what we're seeing kind of from a trend standpoint on geographies, and then I can talk about assets, asset class specifically. So we really subscribe to the concept that there's been an acceleration of trends that we were already seeing pre-COVID. What that means is really acceleration of trends of migration from the Northeast and from the West Coast to Central and Southeast U.S., as well as migration from urban to suburban areas in the country. And there's a ton of data to support this. And now with COVID, that all that's really happened is those trends have been accelerated, happened a lot quicker than anybody expected. And actually, one thing that we tracked, and I can't remember what study we found this and thought it was a great idea, was whether it was PricewaterhouseCoopers or something like that, that you track U-Haul migration or U-Haul routes, because where people are kind of taking a U-Haul and taking
where they picking it up and dropping it off, where they're moving to.
And we have I actually did a little video about this maybe a month ago and posted on my LinkedIn. But there's it shows kind of the true migration for U-Haul data from going from the West Coast to kind of Texas, and from the Northeast down to kind of Georgia, Florida, and the Carolinas. So there's been a ton of migration. And I think Florida and South Florida is going to be a net winner of that migration. And we're seeing this already, that we're seeing kind of huge growth in occupancy of office buildings, desire for residences down here, and all throughout kind of the gamut. I think we're going to see more of that in places like Miami, Fort Lauderdale, and Atlanta. I think is also going to be a big winner. From a geographic standpoint, we really believe in the Southeast, and that's why we've always really been focused in those markets. For us, let me just kind of tell you kind of what we like as markets. Is we look at everything kind of DC down to Florida, and then as far west as Texas. That's kind of what we consider Southeast, and then we kind of draw a line up. So we've started exploring kind of from Texas north, but we're still kind of exploring that more of the kind of the central regions.
So you're not necessarily, and again, I'm assuming you wouldn't necessarily turn away something that made sense, but you're not necessarily looking in the Midwest Chicago region or in the Northwest, Seattle, Ohio, Utah.
So definitely not the Northwest. The central region, in Chicago area, we're exploring. We've done a few deals in Ohio. We find that's a pocket that's been interesting for us. But generally, the markets that we really like are Texas, Carolinas.
How about Nashville?
Georgia.
Like Nashville is. I mean, at least pre-pandemic, I know Nashville was on fire. I was there a little less than 2 years ago now, and we were at the top of maybe it was at the Thompson Hotel. I can't remember, but there was. I mean, I counted 15 cranes just in line sight.
Nashville's a very interesting market. It's seen a lot of growth and a lot of net migration there. We think it's going to continue. Nashville in and of itself is a very interesting market. The other markets in Tennessee are a little bit, they lag a little bit behind Nashville. So it's an interesting market, but I think that it's still the state in itself still lags behind Georgia, Florida, Carolinas, and Texas.
Gotcha. So you're seeing migration to Miami, to Florida, to Georgia, to Texas, and your opinion is that you were seeing these trends pre-COVID, but you believe that COVID has accelerated these trends. And what is your opinion of going to a post-COVID world if such a world exists? I mean, like we were talking previously about Alex has a newborn baby at home. Congratulations.
Thank you.
And one of the reasons I'm wearing a mask today is Alex wants to be extra precautious about that, and I fully respect that.
Appreciate it.
But we're talking about this post-COVID world and what it's going to look like, right? So soon enough people get vaccines, we hit a critical mass. Are you predicting a pullback and a sort of an exodus back into the urban, or do you foresee that this lasts in this suburban world, and this exodus to the right-leaning states, maybe for political purposes, or what do you think seeing in a post-COVID world?
So as I mentioned, I think COVID just created this acceleration. It didn't change that trend. So there was already a desire for people that were already kind of looking to move. Call it, let's just single out New York, even though it's not the only place, but New York, where you have a much higher tax bracket to a state that doesn't have a state income tax in Florida. So there was already this migration or this idea that people wanted to eventually come to Florida from New York.
Yeah.
COVID just was kind of that match that started that fire for them, or not that. I wouldn't even say it's a match. It was like gasoline.
Definitely not the match. It was the gasoline. The gasoline on the fire. Yeah.
It was the gasoline on the fire.
The grill was already on.
Yeah.
So
that's a better.
Yeah, grill was already on. Somebody just didn't have the patience to wait for the coals to slowly come. They pour the gasoline all over it.
So yeah, exactly. So in that respect, no, I don't think a lot of these people are leaving. I think they've come down here because they like the quality of life. They can still work and do a lot of what they were doing up there. And so they're here to stay. I know for myself, 4 or 5 people that I can name off the top of my head that made that move and don't plan to go back. So I think that we're going to see a lot more of that. And it's not just New York. It's also just other places like California. There's been huge migration. You hear every day of a new corporation that's leaving California and moving to Texas. Right? Austin has seen such a boom. Because all these tech companies are saying they can't afford the strict policies and strict regulations in California anymore, and the taxation of California. So they're moving to Texas and Austin and really setting up shop there.
Yeah, and I think it's a natural. I mean, we've talked about this before on the show as well. That it is a bit of a natural progression to get. New York to Miami has always been. It's always been sort of the express flight and easy trip. And so we're going to see, I think, people from the Northeast and the Midwest come to here, and then a little bit more from California towards Texas. They're a little bit more comfortable with like the West Coast, middle America life. It's a very, Texas and Florida are very different. Aside from our tax policies and other such, political standpoints, but we're very different states. Miami's kind of wild. But I'm seeing, what I thought was going to be very interesting was in the beginning, I was seeing people coming to Miami, and people tend to quickly gravitate to what they know. And most people that come to Miami spend a lot of time on Collins Avenue and South Beach, south of Fifth. Maybe Bal Harbor. And so the initial interest, I was seeing a lot of people going there, and there still are. We're seeing some of the biggest sales are on the Venetian Islands and on North Bay Road, Sunset Harbor. But we are starting to see a lot of people recognize Coconut Grove and Coral Gables and Pinecrest that were markets. I mean, those are neighborhoods that, quite frankly, people that live in Miami Beach don't know very much about. So, people that live in other cities don't. Are you seeing? Because Alex, I was going to ask you if you're seeing anything coming to other than on the residential front. Are you seeing businesses come to the Gables, look to the Gables? Are you seeing that sort of development here? And I'll caveat that by saying, like, I always like to call Alex and pick his brain when we're talking real estate shop, because there is very little, I feel, that moves around on a larger scale in Miami without somehow crossing your desk that you might have already somewhat seen that deal or heard about it or underwritten, or the players. And so are you seeing, again, residential side? I mean, we have zero inventory. I just did a search in Gables, Grove, Pinecrest, South Miami, and then I included Ponce Davis and High Pines, and we put all that into the search tool just for a rental for a client. We put a cap of $12,000 and a minimum of 3 single family home. There were 13 homes available in all of those cities to rent right now. So like when I say our inventories are low, it is all-time historic low. But what are you seeing on the industrial, office, retail, restaurant space? Are we seeing development? People coming to these areas?
So in regards to what we're seeing kind of from an asset class perspective, we're seeing a lot of demand for multifamily property. So multifamily from kind of investors just wanting to buy multifamily as to see that asset class is just being kind of very safe, to now leading to more demand for build of new multifamily. So we're seeing quite a lot of new development and repositioning of assets to multifamily. Not so much in South Florida, but across like all our markets, we're seeing a lot of right now is this conversion of downtown office to multifamily. Which is an interesting kind of dynamic we're seeing a lot of right now, right? Especially if you consider CBD office has generally been kind of a sell right now, right? That's a trade you want to sell. And people still like the idea of CBD multifamily because it really attracts a younger population, younger demographic that's living in the city, working nearby. So we've seen a lot of that. Less so much here in South Florida because we generally have a very young downtown. So there's not as many office buildings, I think, as some of these other major markets, or we're still kind of had this concentration, right? That there's a need for those offices there. So multifamily, we've seen a ton of desire for new multifamily. Seen a ton of cap rate compression. We've seen a lot of new development or new starts multifamily. Now, to your comment about rentals and people trying to find places to rent, not so much on the single family side, but even all this demand for rental is going to lead to increased pricing on multifamily on the just kind of units. So I think that's also a good indication for the future growth of multifamily and for the desire for more development here of multifamily. I think we generally still pretty favorable on that asset class down here and really across the Southeast. Industrial also seen a ton of volume. Frankly, we haven't done a lot of industrial simply because banks will be all over that transaction. Banks usually are very happy to do the industrial properties because usually have a 10 hand or the construction is very simple. It's tilt wall construction, goes up pretty quickly. But generally, industrial has been an asset class that has done arguably better during the pandemic. I think we've also seen kind of like values increase this last 12 months. And then you get more into the categories of retail, hospitality, and office. I'd say office is somewhere in the middle. Some have done better, some have done worse. You talked about it before. Office in Coconut Grove is on fire. It's really hard to find good office in Coconut Grove right now because people like that idea of being in a more suburban market within Miami,
but also close to your office. So you're gonna have to trek to downtown. And Coconut Grove is very close to Brickell and downtown, but it's still not the same as hopping in your golf cart and going to work.
Yeah, and there hasn't been a lot of development of new office in Coconut Grove.
Correct.
So it's there's definitely supply constrained. I think in Brickell, we're even seeing that the Class A, the super premium Class A, is getting eye-popping numbers, like crazy numbers that we've never seen here in Miami. Talking about $60-$70 per square foot plus.
$60 to $70 a foot.
Yes, for the super premium Class A.
Yeah, well, we're talking. This is super premium Class A, open views of the water,
yes.
Huge conference rooms. Like elevator right to your half a floor, like
yeah,
the real high.
These are kind of Citadel and these big funds that are the big financial firms from New York that are moving down here and want that and want the super premium space and can afford to pay it and look at it and say, hey, this is a discount to what I pay in New York, and that's why those numbers are working out. So I think office in Miami in particular is actually doing pretty well. Other parts of the country, it leaves something to be desired. Just depends where, and that's why you're seeing a lot of this conversion from office to multifamily.
And retail and restaurant, right? Retail and restaurant. I think pre-pandemic, specifically retail, especially bigger box retail, was on a downward trajectory. Has that shifted? Are we still are we seeing a demand for any of that?
It's interesting. Like so. Bridge Invest focuses on these more esoteric or complex deals, and over the last few months, a lot of complex deals are retail deals, and we've actually been spending a lot of time underwriting and valuing retail, and retail it's not one size fits all, right? It's if you're a restaurant space, you're probably hurting right now, but one company has done extremely well is like Dollar Tree, in a property that we finance that we're currently the lender on right now, and like two other ones that we're looking at for to finance right now, Dollar Tree has signed like leases in the last year, and they're just on a massive growth path. So they've done pretty well. Some big boxes are expanding as well. Some newer concepts are expanding. In terms of restaurants versus just general retail, like I've heard anecdotally that some restaurants, especially more boutique, entrepreneurial focused restaurants, are pretty good about shifting the pandemic for more takeout, sitting outside, and so forth. I don't have the specific stats on that. But I think retail we are looking at right now. We have kind of 3 quotes out right now to do retail financing opportunities. One of them here, one of them in North Florida, and another one in Atlanta. So retail is more just about the right corner. I think the malls are dead. That there's no question that's on its way out.
And you think long term on the way out, pre-COVID, post-COVID, that you just see the decline of big malls, or COVID having a lot to do with that?
COVID having a lot. Again, it's more acceleration of trends, right? Malls were hanging on by a thread, and COVID just made it just was kind of that nail in the coffin. And again, there are exceptions, right? People would say, oh, what about the Harbor? What about Aventura Mall? Yeah, those aren't going anywhere. Those are fantastic establishments that do insane numbers, but that's not your typical.
I mean, I always jokingly refer to Aventura as a city built around a mall and a golf course.
Yeah,
and that's so it's like these are cities that were designed for that, right?
Yeah.
Brickell City Center is it's literally the base, and then right on top of it you have 2 condominiums and a hotel and a hotel condo and some office space, and so it's sort of like it's a vertical city based around the mall itself.
Well, and you're talking now more about the design of future retail, right? And I think Brickell City Center is a good example of that, right? It's not a closed off mall. It actually integrates with the city and the surroundings around it to make it as much of a kind of for you to go through it to get to your next destination as to spend time in there. And it kind of also talks about just what retail is not hurting as bad, right? The strip centers are actually doing okay for the most part, depending on who your tenant mix are or is. It's doing okay because you're kind of stopping there. You go in, you grab what you need, or you go sit down, have food, and leave. It's just the mall itself, that concept, that old 1980s sort of closed mall is what's really has been struggling over the last few years and will continue. So that in short, that's retail. And then last asset class, when we talk about hospitality, our view at Bridge Invest, and I strongly believe this, is hospitality is probably is probably coming back slowly. The assets that are located in more destination cities, so Miami and New York or Fort Lauderdale, areas that are really going to be used for leisure more than business. I think those assets are going to come back quicker, but they're still kind of, I can't remember what report I read that they said that they expected that it to take up to like 2023 or 2024 to come back to valuations of 2020. So hospitality was absolutely the hardest hit. We have a few loans that are hospitality-based assets, and you can see it in those numbers. They were just abysmal. Like, the issue with hospitality is you just have very, very big carry costs, despite no matter if you have people there or not. So it really eats away at any sort of kind of value from the property because you're paying these expenses on a daily basis.
All right, and so that's the last asset class, except for what about warehouse and
that falls into industrial. So yeah, warehouse is really industrial. It's been doing well. I mean, the kind of growth of e-commerce has really helped, or the expansion of e-commerce during COVID has really helped fuel warehouses and distribution centers. I read a stat, and I can't remember off the top of my head, but something crazy like in I think it was like the second quarter of 2020, like was triple or quadruple the volume of sales from like the year from the same quarter the year before, simply because of COVID.
Yeah.
So that creates a huge need for more distribution centers. That'll wane as we kind of go back, hopefully, to kind of normal life. But I think industrial as an asset class has been strong and will continue to be strong.
I don't know if I agree with that, by the way. I think life will begin to go back to whatever levels of normal, but people create habits, and I think it was very difficult for people to get around like online grocery shopping, as an example. And yes, in COVID, especially in the first shelter in place, and when people didn't know what the virus was, and they were wiping down their groceries, people stopped wiping down their groceries a long time ago, right? So, but I've been to the grocery store recently. I don't often go. My wife mostly takes care of the grocery shopping, but I went recently with her and the kids, and there were more shoppers in there that were for the app shoppers, the delivery shoppers, than there were actual shoppers. And I don't see that as a trend that's going to be going away anytime soon. So I just think that people get used to ordering stuff online, the convenience of it, and that I just think that even as the world goes back up, people will go out. I think for leisure, for fun, to get out of the house, they'll go to outdoor malls and spaces. Yes, they'll go to destination hotels. I think I even believe the cruise ship industry is going to come back with a big boom as soon as as soon as everything's really, we hit some sort of a critical mass. But I think certain trends are here to stay, and I think industrial is going to be a huge. I think it's going to continue to be a huge supply issue.
Well, and that's why I think most investors would agree with you. That's why people are willing to buy industrial properties at all-time low cap rates.
All right, and so if of all these, and I guess you handle. It's clear that you specialize in and have to really understand all the various different asset classes and different areas, different demographics. But if you were talking to your audience, which we are now, so what specific asset classes are like really the Bridge Invest favorite? If you were looking right now to write loans and deploy capital, where would you love to spend it?
It's funny, like we don't have a specialty in terms of asset class. I always joke with my team is like, we'll do every single deal that comes to us. It's just a matter at what cost and what leverage point. So it's really about finding those niche deals. Like I mentioned, I think that our business and our main focus for our investors is fiduciaries to find good risk-adjusted returns. So that's a matter of kind of looking where others aren't, right? So if everybody's looking at multifamily, it's either how do we get creative on multifamily, or let's go look elsewhere where others aren't looking. So in like 2014 to 16, we were very, very active in condo land in Miami. There's a huge boom in that growth of that business, and there was very few people doing condo land transactions. So we did. I think at that year we were probably one of the biggest, if not the biggest, land lender in South Florida at that time. We thought that was a big opportunity. Right now, I don't know. We've looked at a few multifamily projects and just going higher up in leverage because we feel comfortable with that analysis. But that's a boring trend that people understand. Like I mentioned, we've looked at a few. Retail I got to walk away from, and we say, wait a second, let's understand what's behind.
So a lot of people might just think big shopper retail is dead, and you go, well, it's all about the spreadsheets. Yep. You got to really look at the numbers.
Yeah, finding value. I think office is one of those where it's like where you can find that diamond in the rough, right? You can figure out what offices are going to survive and which ones are going to change, and are you in a good enough basis where even if it doesn't get knocked out of the park, the analysis doesn't get knocked out of the park, it still makes sense, and you're still in a good deal. I'll tell you one thing that we didn't talk about at all is inflation, which is something that I think is important and something that I've been thinking a lot about recently. Right, when you talk about prices are getting driven up so much, but for homes. Assets are kind of selling at all-time low cap rates. And what is happening here, I think it's a lot to do with the fact that there's a lot of free money. Cost of borrowing has gone down tremendously, and the U.S. government has pumped a lot of money into the system. So we haven't seen inflation in kind of our daily goods, right? Your milk still costs the same, but I suspect that we're in a situation where we're really having a higher than normal inflation rates right now, and we're only going to realize it afterwards. And slowly, our daily goods are going to catch up and going to start costing more as well, because there's just so much money in the system. People are just willing to pay premiums for it, and in fact, that's going to pay premiums for assets, and in effect, is going to cause inflation in the whole system.
Yeah, and they are talking about rates going up now. I mean, most of the lenders that I'm talking to are predicting that we're going to see, especially towards the end of this year, we're going to see significant rate hikes. And so they're, I mean, maybe they're just encouraging people to grab money and they want to write loans, but I think that's what we're headed towards. And would you agree with that?
Yeah, I think so. And I think it's partly to curb inflation, partly to kind of slow down that frenzy of paying a premium for assets.
Well, there you have it, from someone smarter than myself by a long shot. Alex, we really do love having you on the show. Actually, it's easy for you and I to talk. I feel like we burned through 30 plus minutes in what felt like 5. So I definitely would love to have you back on the show another time. I think we're actually planning to do a little bit of a panel type discussion. Maybe as we get a little bit further along in the vaccine herd immunity. But I thank you for coming on the show. Alex can be reached. Their website is bridgeinvest.com.
Yes.
It's again Alex Horn. Alex, thank you for having us on the show. Thank you everybody for watching the show, for being here, for coming to join us for this 30 minutes. And my name again, Levi Meyer with Compass Real Estate, the Meyer Group specifically at Compass. And again, a big thanks to community newspapers for hosting us here in their studio.
Thank you, Levi, for having me on.
Take care.